Amidst one of the worst economic periods in Canada over the past 30 years, it seems like Canadians are getting ready to sell everything to stockpile cash, including their investments like stocks, real estate, and even cryptocurrencies. And it makes sense with what experts are calling the everything sell-off, with some even saying that there's a 98% chance of a recession in the next year. People want to cash out their investments and be prepared for what could be coming around the corner. But warnings are coming out that this sell-off might be a horrible mistake for most people, potentially losing them hundreds of thousands of dollars. So in today's video, we'll learn exactly what is causing this everything sell-off and how you can make sure that you don't make the mistake with the money that you have. But before we do, make sure to subscribe to the channel if you haven't already done so. There's about 40% of people who watch these videos who haven't yet subscribed, so I'd appreciate that. And you can check out the links in the description. When you open up an account with Wealthsimple to either invest in cryptocurrency or stocks, you can get $150 for free. So what exactly is this everything sell-off? Well, the name does a pretty good job of explaining it. Absolutely everything is selling off and going down in value. Take a look at this. This is the S&P 500, a basket of the US's top companies, and we can see it's down almost 25% since the beginning of the year. And the same goes for Canadian real estate with a 4% year-over-year change. And of course, that's far worse in some of these urban centers in Toronto and BC. And of course, this is to be expected with such a volatile asset class, but we've seen cryptocurrencies like Bitcoin and Ether, well, they're down over 60% since the beginning of the year. But why is everything moving in the exact same direction at the exact same time? I mean, these are different industries. Stocks are representations of companies. Real estate, of course, is a totally different asset class, as well as cryptocurrency, but they're all kind of doing the same thing at the same time. Why? They all have one thing in common, though, and that is the interest rate that's set by the central banks like the Federal Reserve here with Jerome Powell from the US, and the Bank of Canada with Tiff Macklem here in Canada, of course. When these central banks raise interest rates, it has a huge impact on many of the assets that Canadians hold their wealth in. For one example, we can talk about real estate. Every single time you see an interest rate go up by 1%, generally each individual can afford 10% less home. So if previously you could afford with your income a $500,000 mortgage, well, when we see an interest rate rise of 1%, you can now only afford $450,000 worth of mortgage. And that's exactly why, even though real estate prices are going down, it's not getting more affordable. Here we can see the average percentage of someone's income that they have to pay to buy the average house with interest rates how they are, and we can see that housing affordability is getting far worse here based on this chart, even though housing prices are down. When the central banks raise interest rates, it's also bad for business because many businesses need to borrow money in order to grow and to operate their businesses. And when that interest rate goes up, well, they have to pay more to borrow that money, meaning that there's less incentive to grow quickly, meaning there's less jobs in the economy. And oftentimes we have lower earnings for those companies, which directly corresponds to a lower stock price as a result of the poorer performance of the business. And these two things stack on top of each other, making matters even worse by destroying something called the wealth effect. And we're going to get into exactly how you can make sure you don't make these major mistakes that happen all too often in negative financial times like this. But first, I really need to hammer down the point of how this wealth effect impacts things. Put simply, the wealth effect is just that people don't want to spend as much money when they don't feel as wealthy. And when they feel wealthy, they want to spend more money. And we can see the impact of the changing values of investments in the way that people spend their money. For example, if your home has gone up in value $100,000 since you bought it, then you might feel more wealthy and go out and spend more money. At the very same time, you might take out a home equity line of credit where you can borrow against that growth in value in your home to spend more money on more things. And this is the exact same for how a booming stock market portfolio can make you feel wealthier and spend differently. This is the wealth effect. And the way that things are going now is we're destroying that wealth effect, right? People's investments have gone down in value. Their homes are worth less. Some people worth less than what they bought them for just a year ago. And as a result, we're seeing far less spending in the economy. And this can be another bad thing for businesses because if we have less consumer spending, then those businesses don't do as well. Their stocks don't perform as well as a result. And also we can have less jobs, more layoffs. And you can sort of see how this thing can cycle and be self-reinforcing and happen over and over again in a spiral. So you might be wondering, why would the central banks like the Bank of Canada and the Federal Reserve in the States, why would they increase interest rates if it has all of these negative impacts on the economic outlook? Well, the key answer here is inflation. They are battling inflation. I'm going to move myself out of the way here so that you can see this clearly, but this is the CPI, the Consumer Price Index, essentially what people use to measure inflation. And we can see here at the beginning of the pandemic, they actually did something to create the wealth effect. They lowered interest rates and printed a bunch of money, and that rose asset prices, making people feel more wealthy and allowing them to go out and spend more money. And that added demand in the market for goods and services resulted in a supply and demand imbalance, which raised the cost of living, right? More people want more things, but there's the same amount of things, prices are going to go up, and that's exactly what we've seen here. And the Bank of Canada has actually specifically said that they want inflation to be between 3% and 1% inside of that range right here. So we have a long way to go, and it's likely that central banks and the Bank of Canada will keep on raising interest rates until they believe that we're going to meaningfully be back in this range instead of up here in the 6, 7, 8%. So things could continue to be bad in markets and might even get worse over the next number of months, but this is where many people make the biggest mistake in times like these. Just yesterday, we saw this headline saying millions of Canadians are losing confidence in the stock market and plan to cash out in the next year. And they got their information from this recent study saying that due to economic uncertainty, a lack of stimulus and money spending programs from the government and the central banks, and rising interest rates, they're taking their toll on the stock market. And investors have responded by saying that 24% of them, well, they're planning on cashing out of the markets because they don't have faith that things are going to even get better. And it makes sense both emotionally and logically. If we're expecting things to get worse, wouldn't it make sense to sell whatever you have before things get worse? Well, that's actually where the biggest mistake comes into play. Let me show you what I'm talking about. And it has a lot to do with your individual investor emotions. This has a big impact on how well you're going to do with your investments over the long term, but we'll get into that in just a second. You can see here that when you buy, even if you're buying at peak, you generally feel good about it. And then if things go down, you think, well, things are bound to recover from now. Things get even worse. I'd recommend, or I guess that we're kind of around in this range right now, but nobody can really know for sure. You're thinking, oh my gosh, all my investments are going to zero. I'm just going to sell everything because I don't have faith. And then it bottoms out, and maybe you feel happy that you got out when you did. And then inevitably things take a U-turn and start going back up. However, when things start going back up again, generally people don't believe that it's going to continue, right? If you're in the mindset of things being negative in the economy, you might not believe that the increases are going to stick around. You think this rally won't last, and then it continues to go and go and go, and then you buy back in sort of halfway through the rally where investments are going up, or even later. This may not sound too bad, but once you realize that most of the investment gains that we see happen on individual days that are very hard to predict when they're actually going to happen, it makes it far easier for you to miss out on those individual days that make up most of the gains that happen in the market. And I think that this is a great example because if you had invested $10,000 in 2002, as of December 31st, 2021, you'd have a balance of $61,685 from your initial $10,000. But if you invested that same $10,000 but were selling and buying back in based on how you were feeling, and you happened to miss the 10 best days during that time, well, that $61,000 return would only be a $28,000 return because, again, most of the highest gains in markets happen on individual, hard to predict days. People are far too focused on timing the market, trying to make sure that they buy in at the exact bottom to make sure that they don't buy things for slightly more expensive than they could have potentially bought it. But the only problem here is that nobody knows when we're at the absolute bottom, just like nobody knows when we're at the absolute peak. People dedicate their lives to this, and I still don't personally believe that anybody knows these things for sure. People are far too focused on timing the market, trying to figure out when the exact bottom will be so that they can buy and make sure they don't pay slightly more than they could have. But the problem with this is that nobody knows when we're going to reach bottom and when we're going to reach the top. And as we've seen in those numbers that I was just showing you, if you time it incorrectly, you could miss the most profitable days because you didn't buy at the right time. Even in negative times like this, it is far better to just hold on to your assets that you have, even if you think that the market might go a little bit lower, because likely over the long term, as long as you have this long-term time horizon, well, things will look a little bit better in the future. Of course, in this situation, I'm assuming that you already have an emergency fund that can support your life expenses for around 3 months and that you're not investing past your risk tolerance. Now, my guess is that most of the people who were in that survey saying that they were going to sell off this year, well, it's likely that they didn't follow these core principles. If you're needing to sell your investments to cover your living expenses, well, it's very likely that you either invested past your risk tolerance or invested more money than you should have in the first place. And for people where that's happened, it might have been a mistake, but it's not too late to fix it and develop that emergency fund and reduce your living expenses by doing things like house hacking, resulting in more dollars on a monthly basis that you can dollar cost average into things like index ETFs that have low fees. And we've talked about these all in previous videos, and you can Google some of those concepts, but we also talk about them in a lot more detail in the Money Mastery Canada course. You can find that link in the description if you haven't checked out the course yet, and you can get 40% off of that course with the coupon code GROW for the next week. And inside of there also you can chat with other course members and me directly inside of the private Discord. But the main lesson to be taken away from this is that trying to time the market and selling when you think it's a good time to sell and buying when you think it's a good time to buy, oftentimes you convince yourself that you're smarter than the market, and for most cases, and myself included, you're not smarter than the market. It's better to have a long-term time horizon and to only invest within your means. But I'm curious what you think about all of this. Do you think that some of your investment plans are sort of in line with this, or are you thinking something else and that I've missed something entirely? Or are you in the situation where the rising cost of living, again largely caused by these central banks, is resulting in you not being able to invest and to sort of look ahead and save for the future? Let me know down in the comments. I read every single one and I try to get back to as many as I possibly can. But with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.